If you're retired or near retirement, how do you take advantage of the recent spike in interest rates? Stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels, and today we are talking about interest rates. Recently, the yield on the 10-year government bond has taken a bit of a spike, and the question becomes, how can you take advantage of that on your own behalf if you're in or near retirement?
Dave, it's great to be here with you and, of course, with all of our listeners. And I think a lot of people want to know, how can I take advantage of what's going on right now, especially with these interest rates when we saw the little bit of a spike there with the 10-year government bond. Right now, interest rates are hanging out around 4.25 to 4.5%. But there is still, or do you think there is still some time that people can take advantage of them?
Well, there are. Of course, and it's interesting because interest rates started gradually coming down on the long end recently, and then shot back up again. But what's happened? Remember, we've had this thing called an inverted yield curve now for many, many years, up until just a few months ago, and that's where long-term interest rates are lower than short-term rates. So we've had that pretty consistently, where the 2-year government bond was paying more than the 5-year and the 10-year and everything else. That right-sized itself, which is good. But also remember, the 2-year, when they have that inversion, that inverted yield curve, that's historically pretty predictive of a recession. And when all of a sudden it starts to correct itself, it's because everyone's assuming the Federal Reserve is going to start lowering short-term rates to combat an infection. Yeah, right. It's an antibiotic to combat a recession. Right. And so what we've had in this case, short-term rates come down and long-term rates just bounce up again, stubbornly bounce up, even with all this tariff talk over the last few weeks.
Yep. It can be a little confusing, but we're here to help you get the message straight. And I want to encourage all of our listeners to call in to that Ask Dave hotline and ask us your retirement questions. The phone number is 800-822-1111. And if we answer your question on a future show, we'll make sure that you get a copy of Dave's Amazon bestseller, The Retirement Income Source, the ultimate guide to eternal income. And our question here comes from William in Connecticut. William says, I've heard that interest rates have crept back up. So shouldn't that affect CD rates favorably?
See, William, it depends upon which interest rates. And again, what's happened recently is short-term rates have come down and just a little bit, and long-term rates have come up. And the long-term rates have come up because of concerns about inflation, whether it's tariff-based or otherwise. Maybe they've come up because of market demands on the long side, because if we fix this, and it's beyond our discussion today as to why it works this way, but we have this trade deficit. Well, trade deficit usually helps keep our rates low because the money that's leaving the country comes back and it gets invested in things like government bonds. Well, now if we fix the trade deficit, that money is going to not be back on our government bonds, which means the yields went up on long-term bonds. But most bank CDs are based upon short-term interest rates. Banks don't like to commit to a 10-year CD rate that's at all competitive, even though the 10-year government bond yield right now is decent. It's in the mid-4s. Banks don't like to do that. So they typically get better rates on the short term. But with everybody now more concerned about recession, the fact is that the Fed might lower rates next as opposed to increasing rates. And if that happens, CD rates are going to continue to come down. So William, I don't think you're going to see any real positive bounce in the CD rates off this. I'd be shocked if that were to happen. If anything, you might see the continue trend downward. So if you need to buy a CD because it makes sense for your goals, then waiting probably isn't the best thing. You're probably better off just locking in and doing the best you can today.
Yep. Well, William, thank you so much for calling into our Ask Dave hotline. Again, that phone number is 800-822-1111. If you call and leave your name and number in your voicemail with a question for the show, if we answer your question on a future show, we'll make sure that you get a copy of Dave's Amazon bestseller. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about what we're seeing with interest rates, what we may see in the future with the Federal Reserve, perhaps lowering interest rates, and really how you can take advantage of it and what you need to do, especially if you're at or near retirement. And Dave, you answered a question from William. William was talking about CD rates, and you said, hey, if you think a CD rate, if a CD will help you achieve your goals, go ahead and buy in now. Don't wait.
Right. And, the problem, though, is for most of our people who are retired or closing in on retirement, the CD is not the right answer. It solves a short-term problem, not necessarily a long-term problem. Because, and again, remember, just to make it clear, when I answered William, I want everybody to be clear that short-term rates are driven by the Federal Reserve. The Federal Reserve can declare those rates, so they can push them upward or downward directly. Long-term rates are driven by the markets, which is why they're driven by things like inflationary expectations, who's buying our government bonds or not buying our government bonds, lots of other factors. Now, the Fed can work to manipulate long-term rates, but they can't directly control them. And for you, if you're retired or approaching retirement, most of your liability out there is probably going to be long-term, right? Because Sarah, think about it, right? If you're retired, God willing, is that a short-term liability or long-term liability?
Well, hopefully it's a long-term liability, and you're looking at 30 years or more of retirement.
That's right. And, if you're saving for a car in 3 years, well, that's short-term.
Exactly,
right?
Short-term.
Or you're paying for college for grandchildren in a few years, that's short-term. But retirement is a long-term financial liability. And you want to, most people agree that insurance companies know how to make money, right?
Yeah, of course.
Right? Everybody listening, I'm sure you agree. Insurance companies,
They
may not want to pay claims, but they know how to make money. And what they do is liability and asset matching. They match short-term assets with short-term liabilities, long-term assets with long-term liabilities. In fact, how some of the regional banks got in trouble just 3 years ago was they didn't do that, right? They were matching essentially short-term liabilities with long-term assets, and they got stuck upside down. And what's even worse than that is trying to match a long-term liability like retirement with a short-term asset, and a CD is a short-term asset. So I think the most important thing I want you to understand as a listener is, look, if you've got a short-term goal and you're going to spend this bucket of money in 2, 3, even 5 years, then a CD is not a bad option because it's going to be safe and you can liquidate that account when it comes due. And again, college for grandchildren, maybe money is a down payment for a second home or an RV, or maybe it's money that goes toward, just buying a car. But if it's something that's there to fund retirement income, then you're matching this long-term liability with a short-term asset. And all of a sudden, the CD comes due at a lower interest rate, and now you renew it at a lower interest rate, your retirement income goes down. And then it comes due again at a lower interest rate, and your retirement income comes down again. And that's not what you want. If you're retired, I'm pretty sure you want to make sure your interest and dividend payments, your income, is steady or even goes up over the long run to combat inflation, not goes down.
All right, Dave, you got it. We're going to follow the insurance companies, make sure that the asset matches up with the duration of time. So isn't that right, Dave?
Hey, it's as simple as that, right? If they know how to make money, then do what they do.
Absolutely right. Well, if you don't want to use a short-term asset to pay for this long-term liability, in retirement, what types of strategies should you be investing in to make sure that you're going to cover that 30 years or more in retirement? We'll be talking about that next. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about ways that you can take advantage of what we're seeing with interest rates going on right now. And Dave, we just talked about, had a great question actually from William. Thank you for calling into the Ask Dave hotline. But William was talking about how CD rates might be affected. And you mentioned CD might be a great thing if you're looking to cover something short term, like purchasing a car or maybe sending a grandchild to college. But you really don't want to invest in CDs if you're trying to cover a long-term investment or long-term liability, something like retirement. So what should people invest in instead? What are some good options for those thinking about these options in retirement?
Well, there are things that are either stickier or that lock in, right? Even dividends on stocks. if you have good quality stocks with a good dividend history, those dividends are pretty sticky. Companies don't like to cut dividends. Now, during the financial crisis in 2008, we had companies cut dividends, uh, especially the big financial companies, because we're worried about systemic financial failure. But barring something that's that bad, a general recession, companies don't like to cut dividends, so they're sticky. But there's also contractual things that people can get in where they have a contractual interest or dividend payment that goes longer than a bank CD. So I think for people, it's just awareness, and it's also this term called disintermediation, right? It's a fancy term which says getting the middleman the heck out of the middle, right? So if you think about what banks do, banks turn around and they lend their money out. So when you put your money in a CD, your money's not sitting there in the bank where just earning interest. Your money's lent out again. That's how they've got it working for them. That's how they're getting interest. And they're making money on your money. So whatever the rate is at which you're getting on your CD, they're lending it out at a higher rate. So disintermediation says you can bypass the middleman. You can go directly and make these types of loans or deals yourselves. In some ways, they're safer than some of the loans made by banks and credit unions and things like that. And keep the money for yourself, not have to support all the bricks and mortar and all the employees of a major bank just because you're invested in one of their CDs.
Yeah. All right. Well, I want to encourage all of our listeners to please call in to the Ask Dave hotline. If you have questions, if you're wondering about whether you should invest in something shorter term, longer term, please call in and ask us your question. That phone line is 800-822-1111. And if we answer your question on a future show, we'll make sure that you get a free copy of Dave's book, Retirement Income Source, The Ultimate Guide to Eternal Income. And our next question here comes from Arnold in Connecticut. He says, Dave, you talk about disintermediation and how we can go directly to purchase these different investments. But how does someone do that? How does someone invest in these types of bonds and bond-like instruments without working with an advisor?
Arnold, great question. And you may want to work with an advisor with this, right? Because if you haven't done this, you may not want to try this at home for the first time. So I don't think working with an advisor is the worst idea. But so let's go to the bank, right? You put your money in a CD and they lend it out. Where do they lend it? They lend it out to people who want mortgages to buy homes, who want to buy cars, to individuals, all right? Now, if you're with a huge bank, let's say you're with, and I know Goldman Sachs doesn't do retail, but Goldman Sachs might, lend money out to corporations, right? Might lend money out to other businesses. And you have to say, well, okay, why can't I do that, right, as a consumer? Lending out to businesses is usually more secure than lending out to individuals that want to buy cars and homes, right? Because think about it. If you have a recession, what is the first thing companies do when there's a recession? They lay people off because they want to continue to pay their debt and not default. So that means here the person who bought the car and took a car loan, bought a house and got a mortgage, they could default on their debt and they can affect the bank. But the bigger firms that have invested in corporations or lent money to corporations, they're going to still get paid their interest payments unless things get so bad that these companies have skinnied their business down so far that they just can't pay the debt anymore. So when you think about this, how do we do this? Well, in the world, we buy bonds, right? When you buy a corporate bond, that's exactly what you're doing. You're lending money to a corporation. You're doing what only the biggest banks might do. Often the banks that don't have very competitive CD rates at all. So why not skip the intermediary, invest in something safer than your bank is probably going to invest in, because you're not investing in individuals buying cars or homes. You're investing in large companies. And frankly, for them to default on that debt, the stock in these companies would have to go to zero value before they default. And you probably already own mutual funds or ETFs or things in your 401k where you already have stock in these funds for a lot of these companies. But the question is, why not just make a loan to these companies, take out the middleman, and be in even a safer spot with a consistent income, more so than the stock you currently own?
Arnold, thank you so much for calling in to the Ask Dave hotline and leaving us your question for the show. We'll make sure that you get a free copy of Dave's book. And if any of our listeners out there, if you have a question for the show, please call in. That phone number is 800-822-1111. And if we answer your question on a future show, we'll make sure that you get a copy of the Retirement Income Source, The Ultimate Guide to Eternal Income. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton. And if you're wondering how you can take advantage of what's going on with the interest rates right now, well, we're here to help on today's show. We're also talking about different ways that you can cover a long-term liability like retirement and making sure that you're investing in longer-term investment strategies. And Dave, you answered a question from Arnold, which was a really good question. Arnold said, hey, I'm putting these words in Arnold's mouth maybe, but I kind of got the feeling that he was maybe a DIY kind of person, someone that said, I like what you're talking about, Dave, but I want to do this myself. So how can I do that? So do you think, are there any concerns with people like Arnold out there that might think, hey, I can do this myself?
Well, it's not rocket science to buy bonds. Or bond-like instruments. I mean, but it's different from picking stocks or picking mutual funds or ETFs because it's a different mindset. If you're picking things that are growth-based, you're more like an offensive coordinator on a football team, right? If you're picking things that are more defensive and income-based, you're more like a defensive coordinator on a football team.
And these are two very different jobs.
They're different mindsets.
Yeah.
They're different mindsets. They really, truly are. Usually you don't cross. You either got the defensive mindset or you have the offensive mindset. And so you have to have the mindset of more of a credit underwriter, like an underwriter that's going to underwrite a mortgage or a car loan for an individual at a bank. That's the person, that mindset, that's going to have to look at the finances of the corporation and say, hey, can they continue to repay their debt? So, I look at it and say the only problem, if Arnold truly is a do-it-yourself type mentality, like you said, then the problem that I have, the concern that I have is, if you haven't done this, Arnold could be smart enough to learn all there is to know about all these bonds and bond-like instruments in different areas and take a couple semesters worth of college courses and learn how to do this type of analysis. But at the end of the day, if he doesn't have a lot of real-world experience, I'm not sure it's the right solution. From what I understand, gallbladder surgery is pretty easy, right? And I'm pretty sure I could learn, go to medical school and sit there for a semester and have some training on how to remove a gallbladder.
You took a semester at medical school, right?
Well, pre-med, yes.
Yeah,
but but the point is, if you need your gallbladder removed and I didn't have any real world experience, you wouldn't pick me.
Yeah, absolutely not. I would not be going to you. I would want to make sure I was with a surgeon or with a financial advisor that actually has that real world experience and can help me out the most when it comes to my investments. Well, we'll continue the conversation and continue talking about why or why not it's a good idea to DIY some of these types of investments when it comes to bonds and bond-like instruments, as well as other things that you need to look out for. I'm Sarah Samuels here with David Scranton, and this is the Retirement Income Source, where it's all about the income. Thank you for spending some time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we've been talking about interest rates and ways you can still take advantage of interest rates, what's going on with the CD rates, what we've seen recently when it comes to bonds and other bond-like instruments. So Dave, what else do you think our listeners need to know when it comes to interest rates and the Federal Reserve? The Fed signaled they may lower certain rates, but what do you think people should prepare for?
Well, I think it's important that people understand that rates are moving around constantly now and in retirement. And any decision they make to capitalize on rates or not capitalize on really depends upon their situation and their goals. Chasing the markets, whether you're chasing stock market returns or whether you're chasing certain interest rates to lock them in, that's secondary to where you are in your life, right? And if you somehow manage to retire right now, but you haven't made the switch to an income first, growth second mindset, you're using a withdrawal strategy, by selling some shares every month, hoping they grow back, that the value goes up, or maybe using a buckets of money approach. If you're doing that and you manage to retire up till now, then you probably want to make the shift like boom, pronto, because you're late. And if we do have a big recession, you may have to come out of retirement. I think it's always important, Sarah, to look at not just what the chances are of something happening, but if that something does happen, what the magnitude of it is to you, right?
Absolutely.
And it's fine if it's a 10 or 20% chance, but if the magnitude to you means you go back to work or will never be able to retire, that's meaningful.
Right.
Even though it's a small percentage probability, you still need to insure against it. And how do you insure against it? By making that transition to an income first, growth second mindset, right? If you're close to retirement and you haven't started the shift, same thing, start making that shift. But if you're 5 to 10 years out and you have started making the shift, then maybe you're fine. Maybe you're on track. But again, I think it's important to stay with it because it's like homeowners insurance, right? The chance, it's okay to go without car insurance collision because in many cases, if you have an older car and you total your car, you can just buy a new one, right? But you'd never go without fire insurance on your house. But the chance of you totaling your car is much, much greater than your house burning down. So why do you insure the house? Well, because it's a more catastrophic loss to you. Even though there's a lower probability of it happening, it means that you've got to come up with hundreds of thousands of dollars to rebuild it. And when you're talking about your retirement, that's what you want to insure. And how do you insure it? By going to that income first, growth second mindset, by making that also important transition.
Absolutely. And I want to encourage all of our listeners, of course, to call in to our Ask Dave hotline. That phone number is 800-822-1111 and leave us your name and a voicemail with your question for the show. And if we answer your question, we'll make sure that you get a free copy of Dave's Amazon bestseller, Retirement Income Source, the ultimate guide to eternal income. Our question here comes from Beth in Connecticut, and she sounds just like some of the people you were just speaking of, Dave. Beth says that she says, I'm close to retirement. I've been waiting for interest rates to go up, but it sounds like you don't think that's going to happen. So should I lock in now?
All right, Beth. Well, I'll answer it two ways. My crystal ball answer, and I hate to give the crystal ball answer because you don't know what's going to happen. But, can rates edge up a little bit? Sure, with the concerns about inflation, with maybe other governments not so willing to buy our dollars now, our government bonds could, with the 10-year government bond rate creep up a bit, sure. But you plot that against the probability of recession, the Fed moving to lower interest rates, maybe the Fed going back to quantitative easing like it had done for a good part of a decade and a half with the starting in the financial crisis where they're not, again, they don't set long-term rates, but they can buy government bonds and drive up the price because of the increased demand and drop the yield. So they can manipulate long-term rates. So when you look at all that, there's just a greater chance rates are going to go down than up in the next year or two. So yeah, the crystal ball says, can you lock in a little higher? Yeah, but is it worth getting greedy? Because the real answer to your question is, if you're really close to retirement, like you said, why take the chance? If you can lock in at 4%, that's a lot better than 3%. That's a third more income. And it doesn't take long for rates to go down by 1%. The Fed just starts lowering rates. Let's say the first time they lower rates, they lower by 0.5%. 2 months later, they can lower by another 0.5%. The long-term rates can come down even more because they overreact. The long-term rates are forward-looking. So you can find 1% shaved off the rates really quickly. So if right now you can get 5.5% in bonds or bond-like instruments, you can go from 5.5 to down to 4 with a snap of a finger in 6 months. And even that is a 25% reduction in your income. So is it really worth the wait to get a couple dollars more? I would say, given where you are in your proximity to retirement, most likely not. Now's a great time to start locking in some of that yield. And it doesn't mean, again, you have to lock yourself out of growth potential, right? If you want to maybe not technically lock in the yield on all of it by buying bonds or preferreds, and you want some common stocks where you have some potential for them to go up in value, or some potential for the dividend to go up in value, then, hey, you can still have some upside. You're not locking it in completely, but at least you've created a bit of a baseline for yourself with those interest rates and with those potential retirement income payments. So again, best advice, don't get greedy and try to time it at the actual peak. Very, very few people can do it. And frankly, those that do, there's a big luck component to it.
Beth, thank you so much for calling in the Ask Dave hotline. Again, that phone number is 800-822-1111. Please call us, leave your name, number, and your voicemail with the question for the show. And if we use your question on the show, we'll make sure that you get a free copy of Dave's book, Retirement Income Source, the ultimate guide to eternal income. And we appreciate you spending some time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we've been discussing ways that you can really get more income out of your portfolio, whether it means you lock in now with those interest rates, just like Beth said. And Dave, I think you made a great point. You said, don't get greedy, right? Don't let the fear of, hey, maybe I can get a few more dollars out of this if I just wait. Don't let that stop you from locking in now, because if you don't, we could potentially see, catastrophic things in the future.
Yeah. Yeah. And, you just don't know. And if you're close to retirement, you've got to ask yourself, am I willing to wait 5 to 15 years to retire if things go adversely? And again, everyone compares themselves to the peak value, right? They compare themselves to the highest my accounts were worth, or the greatest degree to which my winnings were up when I was in the casino, or, the highest interest rate, or even on, if they're refinancing debt, the lowest interest rate they saw. Well, I saw the mortgage.
Becomes a competition.
I saw 2.5% on a 30-year mortgage. If it gets back down there, I'm going to refinance. Well, you don't need to get to the best. You just need to improve your situation. And you can always take a chance, and you can always improve it again in a different way. So, again, the key is looking at where you are in your life, what your goals are, and reacting mostly to that. Not to trying to be the smartest and the best guy in the room to get the best rates or the best returns. For most people, it's not about that. Leave that to the insiders at Wall Street and all their giant egos.
Yeah. It's a joke about, he who dies with the most money wins. And it's like, not really. It's the person who gets to enjoy the rest of their life and not have to worry about market volatility and worry about running out of money. I think that person wins the game of life.
That's right. The person who gets to fulfill their goals and gets to do with their money what's meaningful to them. And for some, it's personal enjoyment. For others, it's legacy. For others, it's doing great things for the community, charitable bequests. But that's what it's really all about, making sure you can accomplish your goals. And Sarah, I wish more financial advisors realize that clients aren't paying them to beat the S&P 500. Clients are paying them to make sure that the client can achieve their goals.
Yeah, little client service, a reorientation, right? Well, we thank you so much for joining us again on this episode of the Retirement Income Source, where it is all about the income.
And most important, we hope that you're here with us next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you've been listening to the Retirement Income Source, where it's all about the income.